The world is a different place tonight than it was when the markets closed on Friday. For weeks, we have discussed the rising geopolitical tension. We have discussed the war premium being priced into gold and silver. But what unfolded on Saturday night across the Middle East is no longer just tension. It is a structural shift in the global order. We have received confirmation of a massive coordinated military campaign designated Operation Epic Fury. According to reports from U.S. Central Command and international news agencies, the United States and Israel have launched nearly 900 strikes targeting strategic facilities across Iran. The scope of this operation is unprecedented. It reportedly targets nuclear sites, military airfields, and command centers of the Islamic Revolutionary Guard Corps. But the headline that is sending shockwaves through the intelligence community, and will likely send shockwaves through the financial markets when they open, is the reported precision strike targeting the high-level command compound in Tehran, which officials say included the residence of the supreme leader. While Iranian state media has denied his death, U.S. and Israeli officials are citing growing signs that the strike was successful. This is a black swan event. Actually, it is what the market calls a neon swan, because the warning signs were there. Remember Friday? Remember when silver ripped 7.5% to $93.72? Remember when gold surged to $5,278? The mainstream media called it inflation fears. But institutional investors were positioning for this risk. The smart money was positioning for exactly what is happening right now. When embassies evacuate and when aircraft carriers move, the insiders buy protection. And Friday's price action was the insiders buying gold and silver with both hands. Now, we must look at the retaliation. Because a strike of this magnitude does not go unanswered. Reports are flooding in of ballistic missile and drone attacks launching from Iran toward U.S. bases across the Gulf. We are seeing reports of strikes near Al Udeid Air Base in Qatar. We are seeing reports of impacts in Bahrain and the UAE. While U.S. Central Command reports no American casualties so far, the psychological impact of missiles flying across the oil-rich Persian Gulf cannot be overstated. This is the heart of the global energy system. It is the heart of the petrodollar system. And right now, it is a war zone. What does this mean for the markets on Sunday night? History tells us that when kinetic war breaks out in the Middle East, the first reaction is a violent flight to safety. Capital flees from risk assets. Capital flees from currencies that are vulnerable to energy shocks. And it floods into the assets that have no counterparty risk. It floods into gold. It floods into silver. On Friday, silver closed at $93.72. That price reflected the risk of war. But it did not reflect the reality of war. Now that the conflict has shifted from rhetoric to active engagement, the global markets are forced to reprice the risk instantly. The market has to ask, what is the price of an ounce of silver if the Strait of Hormuz is closed? What is the price of gold if the global oil supply is cut by 20%? We don't know the exact number yet, but we know it is likely higher than $93. We also have to consider the regime change aspect. If the reports regarding the supreme leader are true, Iran is facing a power vacuum. A power vacuum in a major oil-producing nation creates maximum uncertainty. Will the military take over? Will the conflict expand to involve other regional powers? Uncertainty is the fuel that drives precious metals bull markets. Gold hates stability. Gold historically serves as the ultimate hedge during periods of geopolitical uncertainty. And we have just entered a period of maximum chaos. In the next part of this deep dive, we are going to look at the economic nuclear option, the Strait of Hormuz. We have reports that Iran has threatened to close the strait. We have reports of oil tankers stopping in their tracks. We need to explain why this specific stretch of water is the most dangerous choke point in the global economy. If the strait remains closed, energy analysts warn we could see a return to the historic double-digit inflation levels of the 1970s. And in a world of double-digit inflation, owning physical metal isn't just a trade. It is a survival strategy. While the world watches the missiles flying over Tehran, the real danger to your wallet and to the global economy is happening quietly at sea. We need to talk about the jugular vein of the industrialized world. We need to talk about the Strait of Hormuz. This narrow strip of water, just 21 miles wide at its narrowest point, separates Iran from the Arabian Peninsula. It is the only passage from the Persian Gulf to the open ocean. And right now, it is effectively a high-risk combat corridor. Approximately 20 to 30% of the world's total oil consumption passes through this strait every single day. It is the heartbeat of the global energy system. Following the launch of Operation Epic Fury, reports are flooding in that Iran has threatened to close the strait. More alarmingly, maritime intelligence suggests a complete stoppage of oil tanker traffic in the region. Captains are dropping anchor, insurance premiums are skyrocketing. Nobody wants to sail $1 billion worth of crude oil through a live war zone. If the Strait of Hormuz remains closed, even for a few days, We're looking at an energy shock that makes the 1970s look like a mild inconvenience. Market conditions suggest oil prices are positioned to potentially gap up significantly. Analysts have long predicted that a closure of the strait could push oil to $150, $200, or even higher overnight. Why does this matter for gold and silver? Because energy is the primary input for everything. It costs diesel to mine silver. It costs fuel to ship food. It costs energy to manufacture steel. If the price of oil doubles, the cost of production for every single good on the planet doubles. This brings us back to the hot PPI number released on Friday. We saw wholesale inflation jump to 2.9% before a single missile was fired. That was based on peacetime energy prices. If we add a war premium to oil, that inflation number doesn't go to 3%. It goes to double digits. We are staring at the potential for a hyperinflationary supply shock, and central banks are powerless to stop it. The Federal Reserve cannot print oil. They cannot raise interest rates to open a shipping lane. In this scenario, fiat currency loses purchasing power rapidly against real assets. We are already seeing the first signs of panic in the only market that trades 24/7, crypto. Look at Bitcoin. While the stock market is closed for the weekend, Bitcoin has crashed. It plunged to $63,000 in minutes following the news of the strikes. Over $100 million of leveraged long positions were liquidated instantly. Why? Because in the initial moments of a crisis, cash is king for liquidity. Traders sell what they can, not what they want to. Bitcoin is acting as the canary in the coal mine. It is signaling that liquidity is evaporating. It is signaling that risk assets are being dumped to cover margin calls. But notice something critical. While Bitcoin crashed, the safe haven assets, gold and silver, closed at record highs on Friday. They are not crashing. They are being hoarded. The crypto crash tells us that the risk-on trade is dead. The risk-off trade, the flight to safety, is where we are seeing the most significant capital flow right now. This energy crisis also directly impacts the mining industry. If oil goes to $200, the all-in sustaining cost, AISC, for mining gold and silver skyrockets, marginal mines will shut down because they cannot afford the diesel to run their trucks. So, at the exact moment when demand for safe haven metals is exploding due to war, the supply of those metals could be constricted by energy costs. This is the ultimate bullish storm for commodities. Rising demand, falling supply, devaluing currency. We must also consider the retaliation risk to infrastructure. Iran's response has included strikes on U.S. bases in the Gulf. But what if they target the Saudi oil fields? What if they target the refineries in the UAE? Any damage to energy infrastructure removes supply from the market permanently. This is why some analysts argue the war premium in silver at $93 hasn't yet fully accounted for a total blockade. The market priced in a conflict. It did not price in a catastrophic energy blockade. If the Strait of Hormuz is closed on Monday morning, the price of everything you buy is about to change. In the next part of this deep dive, we are going to look at the immediate market reaction we expect when futures open. We have reports from Thailand that gold trading has already been halted due to excessive volatility. When physical dealers stop trading, it means the price is moving too fast for the system to handle. We will analyze what a limit up open looks like for gold and silver, and we will discuss the historical precedent. When war breaks out, markets gap, and they rarely fill that gap until the conflict is resolved. Stay with us. The economic war is just as dangerous as the kinetic one, and it is just getting started. While the missiles were flying over the Persian Gulf, the first domino in the global financial system quietly fell thousands of miles away. We have breaking reports out of Thailand that confirm the physical market is beginning to seize up. Hua Seng Heng, one of the largest gold trading houses in Southeast Asia, has suspended its online gold trading services. The official reason given? Excessive price volatility. This is critical. When a major physical dealer halts trading, it means the price is moving too fast for their hedging algorithms to handle. It means the spread between the bid and the ask has blown out so wide that they cannot guarantee execution. They are effectively closing the window because they don't know what the real price is. If the price gaps up $50 in a second, they could be wiped out. So they pull the plug. This is the canary in the gold mine. It signals that liquidity in the physical market is vanishing. It signals that sellers are disappearing. Nobody wants to sell their gold or silver when they see headlines about decapitation strikes and closed straits. They hold, they hoard. And when everyone holds and nobody sells, the price goes vertical. We expect similar halts to spread across Asia as markets open on Monday. Dealers in Singapore, Hong Kong, and India will likely face the same issue. If you try to buy physical metal online right now, you might find the buy button disabled, or you might find premiums exploding to 20 or 30% over spot. This is what a liquidity crisis looks like in real assets. Now, let's look at the digital canary, Bitcoin. We mentioned the crash to $63,000. But we need to analyze why it crashed while gold and silver held firm. In moments of extreme geopolitical stress, crypto acts as a risk asset. It trades like a high beta tech stock. When the margin calls come in for leveraged hedge funds, they sell what is liquid. They sell Bitcoin. They sell Ethereum. They raise cash to cover their losses elsewhere. This tells us that the risk-on trade is dead for the moment. Capital is fleeing speculation. But where is it going? It is going to the risk-off trade. It is going to the assets that have stood the test of time for 5,000 years. It is going to gold and silver. The divergence between Bitcoin crashing and gold holding its record highs is the market voting with its wallet. The market is saying, I don't trust the digital ledger in a war, I trust the physical bar. This brings us to the Sunday night gap. We are counting down the hours until the Globex futures market opens for the week. Based on the severity of the strikes, over 900 sorties, strategic infrastructure targets, and strikes on high-level command centers, and based on the threat to the Strait of Hormuz, analysts are projecting a massive gap up in precious metals. Gold closed at $5,278 on Friday. It is entirely possible we see it open above $5,400. Silver closed at $93.72. A 10% gap, which is not unheard of in war scenarios, would put us well over $100 instantly. We could see silver open at $103 or $105. This would align perfectly with the price we saw in Shanghai last week. The war has effectively forced the West to reprice its paper silver to match the East's physical reality. But a gap up is dangerous for traders. It leaves a void on the chart. It creates panic buying at the open, followed by potential volatility as the initial news is digested. However, in a war market, gaps often do not fill. They become breakaway gaps. The price jumps to a new level and never looks back. Traders who are waiting for a pullback to buy might be waiting forever. The discount window closed on Friday at 4 p.m. The war premium window opens on Sunday at 6 p.m. In the next part of this deep dive, we are going to look at the mining stocks paradox. Historically, in a broad market crash, mining stocks can sell off initially with the general equity market. If the S&P 500 crashes on Monday because of the war, investors might sell Newmont and First Majestic to raise cash, even if gold and silver are skyrocketing. This creates a massive dislocation. It creates a buying opportunity of a lifetime. We will explain why you might see gold up 5% and gold miners down 5% in the same hour, and why, if the price gaps up $50 in a second, they could be wiped out. So they pull the plug. We are now in the calm before the storm. The physical markets in Asia are waking up to a new reality. The Thailand gold halt was just the first tremor. But the main event happens when the Globex electronic futures market opens for trading this evening. Based on the severity of Operation Epic Fury, the significant geopolitical escalation we saw over the weekend and the resulting impact on global energy corridors against U.S. bases, market makers are bracing for a historic gap up. Let's look at the math. Silver closed the week at $93.72. In previous geopolitical shocks of this magnitude, like the invasion of Ukraine or the initial Middle East flare-ups, we have seen commodities gap up 5, 10, or even 15% on the open. If silver follows historical wartime patterns of a 5 to 7% gap, we could see psychological resistance levels tested. We open at $100.28. This would immediately align the U.S. paper price with the physical price we saw in Shanghai last week. The war has effectively forced the arbitrage to close. It has forced the West to admit that $93 was too cheap. For gold, a similar 5% gap would push the price well over $5,500. We are looking at a repricing event that happens in seconds, causing a rapid repricing that may make it difficult for late entrants to find a stable entry point. However, there is a trap that you must be aware of. It is a phenomenon known as the mining stock paradox. And if you are holding shares of Newmont or First Majestic, you need to listen very carefully. History tells us that when a massive war breaks out, the general stock market crashes. If oil spikes to $150 because the strait is closed, the S&P 500 and the Dow Jones will likely plunge on Monday morning. Companies like Amazon and Apple cannot make money if shipping stops, and energy costs double. So the algorithms sell the S&P 500. And here's the problem. Most mining stocks are part of the general indices or ETFs. When a massive hedge fund faces a margin call because their tech stocks are crashing, they don't sell what they want to sell. They sell what they can sell. They sell their winners. They sell their gold miners. This creates a massive dislocation. We could see a scenario on Monday where gold is up $200, but Newmont mining stock is down 5%. New investors look at this and panic. They think, why is my gold miner falling if gold is skyrocketing? The answer is liquidity. It is a solvency crisis, not a value crisis. The market is selling the miner to raise cash to cover losses elsewhere. But this dislocation is temporary. And for the smart money, it is the buying opportunity of a lifetime. Why? Because while the stock price of the miner is falling, the profit margin of the miner is exploding. If gold hits $5,500, Newmont is printing billions of dollars in free cash flow. Eventually, usually within a few days or weeks, the market realizes this. The selling pressure stops, and the mining stocks slingshot higher to catch up with the metal. We saw this in 2008. We saw it in March 2020. First, they dump the miners with the market. Then, the miners decouple and go vertical. So, if you see red on your mining screen on Monday while gold is green, do not panic. Understand the mechanic. It is a liquidity flush. It is the weak hands transferring their shares to the strong hands. The strong hands know that a miner earning record profits in a war zone is worth infinitely more than a tech stock that can't ship its product. In the final part of this deep dive, we are going to give you the specific action plan for the week. We will discuss what to do if you hold physical metal. We will discuss what to do if you are looking to enter the market. And we will give you the final warning about the Strait of Hormuz. If that water remains closed, the inflation data we saw on Friday is irrelevant. We are heading for a world where the dollar buys significantly less of everything. We interrupt this analysis with a breaking development that fundamentally alters the trajectory of this crisis. We have just received official confirmation from Iranian state media. Both the Tasnim and Fars news agencies, the official mouthpieces of the state, have confirmed the death of Supreme Leader Ayatollah Ali Khamenei following the strikes in Tehran. This is no longer a rumor. This is no longer a fog of war speculation. It is a confirmed historical event. A major shift in leadership has occurred following the recent military developments. Regardless of your political stance from a financial perspective, this is the definition of maximum instability. It creates an immediate power vacuum in one of the world's most critical energy producers. It raises the question, who is in charge of the ballistic missiles? Who is in charge of the closure of the Strait of Hormuz? The Islamic Revolutionary Guard Corps, IRGC, is now likely operating under emergency protocols. And historically, when a regime faces an existential threat, the response is often asymmetric and extreme. This news effectively locks in the Sunday night gap. When the Globex futures market opens in a few hours, the algorithms will not just be pricing in a conflict, they will be pricing in systemic shift, an unprecedented escalation. The risk of the Strait of Hormuz being physically blocked or mined is being viewed as an immediate and critical certainty by risk managers. If the strait closes, the oil market breaks. And if the oil market breaks, the global economy faces an immediate hyperinflationary supply shock. So here is the war room action plan for the week ahead. This is not financial advice. This is a survival strategy for your wealth in a time of chaos. Point number 1, do not panic sell stocks. If you hold general equities, Monday morning is likely to be ugly. We expect the S&P 500 and the Dow to open significantly lower as the market digests the oil shock. However, panic selling into a crash is rarely the right move. Often, the plunge protection team or central banks will step in with liquidity to stabilize the markets. Wait for the dust to settle. Understand that the volatility is driven by algorithms reacting to headlines, not necessarily the fundamentals of every company you own. Point number 2, sit tight on physical metal. If you follow the data we discussed on Friday, the PPI inflation, the bank deliveries, the war risk, and you hold physical gold and silver, you are in the lifeboat. Do not be tempted to sell into the spike on Monday just to take a quick profit. This is not a trade. This is insurance. The insurance policy just paid out because the house is on fire. You do not cancel your insurance while the fire is still burning. The premium on physical coins and bars is likely to explode this week. Dealers like Hua Seng Heng in Thailand have already halted trading. We expect US and European dealers to either widen spreads massively or run out of inventory entirely. If you have it, hold it. It is your shield against the currency devaluation that comes next. Point number 3, avoid leverage. I cannot stress this enough. The volatility we are about to see will be unprecedented. We could see gold up $200 one minute and down $100 the next as margin calls trigger liquidations. If you're trading futures with leverage, you can be wiped out even if you are right on the direction. This is a market for ownership, not gambling. The mining stock paradox we discussed in part 4 is real. Be prepared for dislocation, be prepared for miners to lag the metal initially, but trust the fundamental profit margins. Point number 4, watch the strait. The single most important indicator for the rest of the year is the flow of oil tankers through the Strait of Hormuz. If that flow stops, the inflation numbers we saw on Friday are irrelevant. We will be entering a new economic paradigm. A world of $150 oil and $100 silver is a world where the dollar buys significantly less. We are witnessing history. The old order is fracturing. The new order is being born in chaos. And in times of chaos, gold and silver are the only constants. They have survived every empire, every war, and every collapse for 5,000 years. They will survive this too. If this deep dive helped you navigate the chaos of the last 48 hours, please hit the like button so we can reach more people. And please subscribe to the channel. We will be monitoring the market open closely and will bring you updates as the situation evolves.